Hello everybody. So today I have a short video when I want to talk about three small caps that I own, although I'll say right now my position in STEM and Indie, they're almost meaningless, right? It's well under 1%. HIMS is a bigger position for me, and HIMS is the stock out of the three here where I have the most conviction. Nonetheless, depending on each investor's preference, I wouldn't have any problem with any investor having a preference for any of these stocks. They all have great things going for them, and that's why I want to cover them today briefly. And I called this video the small cap debacle because I only have 2 slides in this video, and you'll see in the next slide I'll show you how down these stocks are. And I don't understand why these stocks are so down, aside from the market is saying, oh, small cap equals risk, and let me go buy bonds and let me get, a guaranteed devaluation of $1 because I go buy bonds because bonds pay 5%. Or, there's this attraction of high caps and there's just very little liquidity for these stocks right now. And that's why they're so cheap. It's insane to me because they're doing really, really, really great. So my favorite out of the three is HIMS, but don't let that make you think that STEM or Indie are bad stocks in any way. It's just that I have an outsized exposure to Tesla, and because my position in Tesla is actually nearing 40% now because I've been adding this past week, because my position in Tesla is so big, STEM and Indie, they kind of compete with Tesla a little bit, so I'm a little more careful. HIMS is my number one position in healthcare. So let me tell you what I like about all three of these stocks. First of all, revenue growth for HIMS plus 59% next 12 months predicted. Insane, very high in this recession. And by the way, this is a recession proof. If we're talking about companies like Tesla not being able to sell their cars, companies like Enphase not selling their $30,000 solar installs because of interest rates, HIMS is ED drugs and air loss drugs. People are not going on debt to spend $45 a month on hair loss spray. They're not going on debt on that. And so that's why I don't understand that HIMS is down so much, actually almost 50% down in 6 months for a stock that's supposed to be recession proof, right? STEM and Indie, you could understand a little bit because they're both related to the energy industry. STEM sells really expensive energy systems, and Indie is related to the auto industry. So you could understand these stocks being down per the macro narrative, but not HIMS. I don't understand HIMS being down per the macro narrative. But this macro narrative makes no sense because interest rates are going down. They have to go down. Otherwise, if they don't go down next year, pick your Main Street bank that's going to go bankrupt next year. Pick it. Pick any. That's going to happen if those rates don't go down. Anyways, moving on. So, revenue growth plus 59% for HIMS, very high. STEM's plus 86% next 12 months predicted. And Indie plus 96%, exclamation mark, plus 96% predicted over the next 12 months. So let me start telling you about HIMS. HIMS is cash flow positive. They've achieved in Q2, they have achieved cash flow positivity. For the full year of 2023, they're predicted to be about a 4 to 5%, let's call it a 5% adjusted EBITDA margin, right? Between 35 and 40 million of cash flow positive. So this is a company that is now generating cash. Bankruptcy is not in the cards for this company, and yet it is trading like it is, right? It's almost trading like a penny stock. And the long-term guidance, you may remember my full video that I've made about HIMS, about their long-term guidance and about how they're on track to reach it more than 6 months early, right? They may actually reach it almost a year early. I made a full video about this. Their long-term guidance gives us clearly 100 million in adjusted EBITDA. So calculate EV over adjusted EBITDA. It's getting ridiculous. The forward EV over adjusted EBITDA for HIMS is dirt cheap for a company that is still growing very fast. For a company that is well positioned to take advantage of many new drugs that they're going to be able to sell prescriptions for. And for a company, may I add, where the CEO has guided by the end of this year, a weight loss product is being launched. Right? HIMS will be a beneficiary of the whole weight loss craze that is going on right now, right? May I remind you, the biggest company in Europe right now, the maker of Wegovy, is a $400 billion market cap, because how revolutionary what's going on with these GLP-1 inhibitors drugs are. They seem to be pretty revolutionary. HIMS is positioned to take advantage of that. And that's probably, because it hasn't happened yet, because they haven't rushed into it yet, that the narrative hasn't turned. But over the long run, I'm very positive about HIMS, and I'm very happy to own it. Let me move to STEM. So STEM should be cash flow positive through 2024. If you don't know about STEM, what does STEM do? STEM, the main business for them, is still installing megapacks. So they install, their number one product that they install is the Tesla Megapack. Tesla is the number one supplier of STEM. STEM installs these Megapack, but also STEM has a lot of privileged relationships with a lot of suppliers in China, and they install a lot of Chinese Megapacks. These Chinese Megapacks directly compete with Tesla's Megapacks. So STEM is kind of this hybrid where they both co-compete and compete with Tesla. But the guidance was reaffirmed, right? This August, when they reported earnings, they reaffirmed the guidance. And STEM is operating at the heart of a sector that is growing tremendously. And this is an excerpt from the Tesla the Tesla investor presentation that was released last week. And in the Tesla investor presentation, we've learned that storage, i.e. the Megapacks, is up 90% year over year. STEM mostly operates in the installation and the setup of these Megapacks. They mostly operate of this sector. They have a little bit of a solar division that they just acquired as well. They acquired a solar division, and so that solar division, I expect, is struggling a little more. That's not the bulk of the business for STEM with the Just Energy division. The bulk of the business for STEM is installing these front of the meter and behind the meter Megapacks, and that is up 90% year over year for Tesla. So that is why we see eerily similar predicted growth for STEM at plus 86%, because they are the pure play in the Megapack, in those giant battery packs. They are the main pure play in that sector. And yes, in the comment section, I know people are going to tell me, oh, you need to analyze Fluence. I haven't gotten around to it. I will analyze Fluence at some point, but I haven't gotten around to it. So STEM, again, you'll see the stock price way down. I do not understand. They are at the heart of a highly growing sector, and they will be cash flow positive in 2024. And then the last stock in this space is Indie. So Indie Semiconductors, I think a lot of the reason actually for Indie Semiconductors to be down is that some of their product mix includes radar and LiDAR, and they did a few acquisitions in radar and LiDAR. And of course, a lot of people in the market are believing right now that radar and LiDAR is not the future. I don't think it's the future myself. But I do think for drive assist systems, a lot of OEMs are going to keep installing them and setting them up, and eventually vision, I think, for Indie will also replace the radar. And they just announced a great system on a chip for vision recently, and they are the supplier. They are trying to be the premier supplier of semiconductors for the auto industry that competes against Tesla. So they're kind of like, NVIDIA is an enabler of the auto industry competing against Tesla. They enable that. Indie also enables the auto industry to compete against Tesla, which again, Tesla is my biggest position. So that's why I understand why Indie is a small position for me, because Tesla is my biggest position. Does it make sense if your biggest position is Tesla to invest against Tesla would-be competitor, albeit for just a small portion of their business? Maybe not. It could be an edge, right? It could be an edge, but these are small positions for me. But nonetheless, what's outstanding and what is true is the revenue growth. The revenue growth for Indie Semiconductors is predicted to be plus 96% revenue growth over the next 12 months. In Q2 2023, the conference call, let me read you this from the conference call, from the CEO, right? We remain on track to more than double our annual revenues for a third consecutive year. That's amazing. That's amazing, right? Because the stock has been well over halved, but the revenue if the revenue is tripling. So revenue triples, the stocks get halved. That's a 6x delta right there. Okay, and reach profitability in the fourth quarter of this year, driven by sustained sales growth, gross margin expansion, and operating expense leverage. So they're guiding for profitability in Q4. Now, I know they're reporting Q3 in about 10 days from now. So, of course, Q4, that's like 3 months and 2 weeks out. The market doesn't look at Q4. The market doesn't care about Q4. It's 3 months out. Come on. Mr. Market doesn't look at that stuff. Profitability, okay, you gotta wait 2 quarters. But anyways, if you look at the revenue growth, it's outstanding. That growth in revenue has been outstanding. And this stock, in my view, going into the earnings has been de-risked, because if you go on their investor relation website and you can see, sometimes they update guidance upwards, sometimes they update it downwards, like SolarEdge, for example, did a few days back. This is what we know. Okay, so what do they tell us? Preliminary revenue outlook. They expect revenue, so they've reached the higher end of their guidance, and they expect their revenue to now be above 60 million and higher than the higher end of their guidance. So they're guiding us before the earnings that revenue is going to be higher than what they had guided us for. So this is a business whose revenue growth has actually accelerated. So these small cap stocks, are chugging along. Their business is operating as usual. They are doing well in the business, and we see this disconnection, in my view, between Mr. Market's ignorance and the ignorance of a price given by Mr. Market. And I believe the CAPM is false. The capital asset pricing models that, if you got an MBA in finance, if you got your finance degree, markets are efficient. The price is never wrong. Right, as Warren Buffett says, I'm very grateful for MBAs teaching the efficient market hypothesis, because if MBAs didn't teach that, then there wouldn't be a lot of opportunities for me to buy stocks, right? And I guess I'm grateful for that too. But there's clear inefficiencies, especially when a company's business is accelerating. When the CEO is releasing a statement saying it's accelerating, and look at in the case of Indy's trading at $5, is down 30%, almost 35% in 6 months, and the short interest is 17%. Right? For STEM, going backwards to STEM is trading at $3. This is insane. I remember discovering this stock when it was at $5 and liking it at $5. So now it's trading at $3. It's down 77% year over year. Short interest is 28%, and we know they are going to be cash flow positive in 2024. All right, this stock used to be criticized because it wanted to spin itself as a software stock, which it is, by the way. Over the long term, STEM is a software and revenue service stock, right? Because when they sell these battery packs, they have to service them, and they attach software. So it is a software stock in the long run, but the market is giving no credit to a company like STEM for its software division. The Athena software, it is giving no credit. And if you've been following my channel for a long time, I've did a full comparison of Athena versus AutoBidder. AutoBidder is Tesla's energy trading software. Athena and Tesla's trading energy software are competing head to head. They're fairly similar software, right? STEM is getting no credit. It's trading as an installer of Chinese battery packs. That's essentially what it's trading at. An installer of Chinese battery packs. 30%, I'm rounding it up to almost 30% short interest. Market cap, $473 million, right? Indy market cap is $873 million. So these small caps are getting hammered through no reasons of their own, in my view. In fact, if you look at the returns of small cap growth stocks, like if you look at ETFs, and all of the small cap growth stocks, you notice a major delta between say the triple Q, the NASDAQ, and small cap growth stocks. So small caps have been left out by this market, and it is an opportunity, in my view, for the stock picker here. The last one is HIMS. So HIMS is a bigger position for me. Who who knew HIMS would be 50% down compared to 6 months ago? If you go back further out than 6 months, it's actually a little higher, right? This is HIMS is a long-term hold for me, but at 578, I mean, this is a dirt cheap stock, and I've been adding to HIMS the most actually out of these three stocks, because HIMS, I didn't put it in this video, but we know HIMS ranked as high as number 4 on the Apple Store for health apps. So the business of HIMS is doing well. They have a new product coming out for heart health, exclusively heart, not heart and ED, right? Heart and ED was something they introduced last quarter. Now they have an exclusively heart product coming out. Anyways, a dirt cheap stock, but obviously, in my view, owning these stocks, like I don't own any of these stocks for anything before 2030. These are 2030 onward holds. These are stocks that I want to own until 2030, and this is my style of investing. And in my style of investing, it's either a 10 or 20x, hopefully more, right? Because could any of these be 100 baggers, right? Could a stock like STEM be a 100 bagger? Is it, for example, possible to imagine a stock like STEM be a $47 billion company with a dilution of the US dollar that's going to happen over the next 10 years? And with how important these mega packs are going to be to the electric grid in the future, is that possible? Could be in my view. But to me, these stocks I own until bankruptcy, or I own until a 10x, and it only takes a few multi-baggers to make up for your losses, which is also something, that I've learned over the years. It only takes a few multi-baggers to make up for these losses, right? Only. So anyways, it makes very little sense why these stocks are so cheap. I do not understand it. This is obviously not investment advice. This is not investment advice, just entertainment. I hope you liked the video. I hope you were entertained. Please comment. Please let me know what you think in the comment section. Please subscribe if you can. Like, it really helps get the videos out. And I appreciate you watching. Have a wonderful day. Thank you.